Hello, everyone, and welcome to the New Capital webinar Q1 Market Review. My name is Catherine. I'm the Director of Communications at New Capital. And to get us started, I will read the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Thank you for your time on that. And we will go ahead and bring Leonard in and we can start looking at the results of that poll as well. Welcome, Leonard.
Good day, Catherine. How are you?
Nice to see you.
Nice to see you. We're just kidding. We've been working for the last hour to get all the tech just so, and we're going to hope it's just so. All right, Q1 of 2024. We'll do a quick review of what went on in the first quarter, and here it is. These are New Capital's model portfolios, all the way from Model 1, 10% bonds, all the way to Model 10, 100% stocks. And you can see it was a good Q1 for financial markets. Both stock markets more than for bond markets. But our bonds actually did very well in the first quarter because we're holding mostly short-term bonds. And it was long-term bonds that had a very difficult first quarter as the market came to grips with the idea that interest rates were not going to go down. That hit long-term bonds, but not so much short-term bonds. And as I've talked about in many of our past webinars, right now, we are highly geared toward shorter-term bonds because they're paying high interest rates without having much interest rate risk. And so you see that the more stock in your portfolio, the better the portfolio did, because the stock market had a very strong first quarter, and that continued on a very strong 2023, annual 2023. And so in other words, I'm sure most people know the strength of the stock market continued from 2023 and into the first quarter of 2024. So an all stock portfolio, Model 10, 6.65%. And then, from there, your performance depended upon your stock allocation versus your bond allocation. And then you can see our performance. This is just the Model 6 60/40 portfolio. NCM's model portfolio did slightly better than the global portfolio, slightly underperformed the US only portfolio because our model portfolios are global portfolios, both in terms of stocks and bonds. And the US stock market had a slightly stronger performance than global stocks, and that continued a trend that's been at work. I'll talk about that, and I'll talk about where valuations are, as I always do. But even the global portfolio had a nice, strong quarter, 4%, whether it's 4.37, 4.05, or 5.63. That's a strong quarterly performance. If you extrapolate any of those out to an annualized performance, that's 16 to 20% returns on an annualized basis. You'll take any of those. So it was a strong first quarter. We move into the economy now, and you can see that inflation has recently reduced very substantially. we were facing 9%. Look at that, 9% inflation, but very briefly in 2022. Look at that. It peaked at that point, and then it's been a steep decline. Just as it was a steep rise, it was a steep decline in inflation as the Federal Reserve raised its interest rates to slow inflation. And of course, that's not the only way that inflation is slowed. Supply comes into markets, right? And so anytime demand is high and supply is low, you'll get higher prices. And so, as I've often said, this is not my saying, but it's a saying that the cure for high prices is high prices, right? In other words, high prices are their own cure. Anytime you have high prices in something, you generally will see supply enter the market. And so all of those factors, whether it's the Fed raising interest rates or supply coming online, have helped to lower our inflation. But it's not at 2%. 2% would be, you know, somewhere around right here, and we're not seeing that, although we're not super far off. What we're seeing in inflation right now in March of 2024, and the month just ended, 3.5%. Headline CPA, another way to look at it is core CPI, 3 point, but anyway, 3.5, 3.8%. And that's pretty close to the 50-year average. Look at that, everybody. Over the last 50 years, we've had periods of high inflation, sometimes very high, as we can see right here, right? Look at that, back in the 70s. I remember that. 15% inflation. But we've had periods of low inflation. Look at this very long period of the 1990s and into the 2000s. So this wasn't a special shock for people coming out of the pandemic. To hit this point was a very much a surprise for many, many people. And they're still feeling the effects. And by the way, I think that the government has not done a very good job of explaining to people what slowing inflation means. Slowing inflation does not mean that prices go back down to where they were. It just means, of course, that the rate of price increases is slowed. And I really think that many, many people, as they heard that the government was working to slow down inflation, what they heard was the government is working to go back to the old prices. That is not what the government was working to do. And we are more than likely, I mean, really more than likely, almost to a certainty, not going to see the prices that, you know, that we saw right here, over here and going forward. And so I think there's a lot of anger that comes out of what essentially was a failure to communicate. And I would hold the president of the United States liable for that as well. I don't know if Joe Biden went out and said, let me explain. And that's what the president should be doing, is being the educator in chief, the explainer in chief. Should have been saying, look, we're going to slow inflation, but I don't want anybody to think we're going back to the prior prices. That's not what lower inflation means. It just means that the rate of increases is going to slow. Now, look at this slide. There's a reason I asked everybody about their auto insurance rates. Take a look at the most recent readings, 2024. So what this is, these are contributors on the left to headline CPI inflation, and it includes all the different components: energy, core goods, what's called shelter, food at home, dining, recreation, and other services. And then in this chart, and by the way, I'm grateful to JP Morgan, one of our large business partners, one of our 4 biggies. They do a great job putting out this deck of slides that I rely so heavily on. It's called the Guide to the Market. You can get it if you want. I get it because I do want. And they began to publish their Guide to the Market slides 20 years ago. It's the 20th anniversary of the guide to the market, just as it is now the 20th anniversary of New Capital. So JP Morgan began to publish these slides, and for a long time they published the slides on a quarterly basis, and then they went monthly, now daily. They update the numbers in the guide to the market daily. So it's a really wonderful service to the world, really. And certainly it helps me because I couldn't create these slides on my own. Anyway, so here you can see, look at the auto insurance. Now this is everything, but look, auto insurance in May of 2022 as a percentage of auto insurance inflation, as a contributor to total inflation, look at it back here. It's a little sliver. Look at it now. And now over on the right, if we take out shelter, right, and we focus only on certain services, if we focus only on the sector that auto insurance is part of, right, which is core goods and other services, the single largest occupier of that segment of the inflationary categories is auto insurance. And look at the change that automobile insurance has gone through. From occupying a tiny sliver of its own category to being a dominant piece of contributing to inflation. And I have read press releases and looked at some of the reports coming from the auto insurance companies. Progressive, the CEO, they gave a report to Wall Street, and they're expecting 50% increases in their profits. I told you about my experience with Geico. They wanted to raise my rates from $4,000 to $16,000, 4 times. So driving has gotten very expensive, and what I read also indicates that one of the reasons is that there are no more minor fender benders. All the computers and sensors and so on that are in automobiles now, every time there is an accident, the repair bills are through the roof. So we'll see where the industry goes. The idea that we would have self-driving cars, I think, is going to become front and center again as an issue, because a self-driving car holds out the possibility that you would not own, if you were driving it in self-driving mode, that you would own a car in which you would not have an at-fault accident. You may have an accident, that car may get hit, but theoretically, a car full of sensors and knowing where the street is and the stop sign and so on that's driving for you would not result in an at-fault accident. And if this continues with automobile insurance, I think we're going to see self-driving cars a lot sooner. The public's going to demand it. Nominal and real yields. This is the 10-year Treasury right here, the yield on the 10-year Treasury dating back to 1958. And you can see that the lowest point it hit was right here. This would have been August of 2020, right there, the low point. During the pandemic, August of 2020, the yield was 0.5% on the 10-year Treasury bond. And at that point, New Capital said, no, we're not going to hold those bonds. And we saved clients a tremendous amount of pain, because look what's happened. The 10-year Treasury bond's gone from 0.5% in yield to 4.6% in yield, much more business-like. We're happy to own these bonds here, although we're not overdosing on them. We don't own much of them. And then this is the real yield. This is the real yield. So this is the gray is the nominal yield minus inflation, gives you the real yield, the yield on the 10-year Treasury bond after inflation. And we went negative here for a while. Look at that, negative real yields. We're back in positive territory, though not strongly. we have right now real yields of 0.82%. In other words, on the 10-year Treasury bond, you are getting 0.82% yield above 3.8% inflation. This plus this equals the nominal yield. It's a lot better than where it was here, but it's not near the average between 1958 and the present. The average yields between 1958 and the present, inflation has on average been 3.8%, not 2%, not even 2.9%, because of that huge period of inflation in the 70s. And real yields have on average been 1.94, close to 2%. We're close to 1%. So real yields right now are about half. And that leads further credence to the idea that the Fed may be in no hurry to lower interest rates. If real yields are 0.82%, we've historically seen 2%. Granted, we had a very, very high period of inflation, but it averages out. Here is the global economy and how it's looking. We have some trouble points. This is the Purchasing Managers Index. It's one way to measure economic activity. We've got a little bit of warning signs in the euro area, some slowdown there, but in general, things are looking pretty good. India, super, super high growth going on in India right now, and our portfolio has Indian stocks in it, so you're participating in that. Really, India is the big bright spot in the global economy in terms of its activity. Emerging markets, look at this. We have an allocation for you in the portfolio. Emerging markets, also green, not as strong as that. And China's actually looking okay right now after a big slowdown. Russia not even included because it's basically banned from the global economy given its invasion of Ukraine, and it should be banned in my view. But things look pretty good. Here's the US right here. We're sort of yellowish, but not nearly the red that we had here during the pandemic. Then, of course, we have the Euro crisis right here, right? We had the Brazilian economic crisis here, and then this was the global financial crisis. And you see why it was called the global financial crisis. Look at that, red top to bottom. We're going to take a look at bonds now. Here is the federal fund rate and its expectations. Let me go back. So this is showing that expectations, this is where we are right here. This is actual. The Fed funds rate, 5.38%. That's the rate that the Fed loans to its banks at. The expectations, the Federal Open Market Committee year-end estimates last year were that we were going to be here. Market expects this. Market says, nope, we're not going to see that. We're going to see higher rates than whatever the Fed announced. Here's the Fed's long-term projection for where the Fed funds rate would be. But this is what the market expects. This is a news headline from today from the Wall Street Journal, which has an exclusive story from some inside source. Trump allies draw up plans to blunt Fed's independence. Some Trump advisors argue that the president should be consulted on interest rate decisions and have the authority to oust the Fed chair. And all I can say is that one of the great features of the American financial system is that the Fed has some independence, right? It's an organization which is able to make decisions without too much political interference about what should be done to balance between its dual mandate. Number one, to keep inflation low, and number two, to keep employment high. And it has to balance those two mandates. Those are the original two mandates, and they're good mandates. In other words, in my view, the two things that the Fed is targeting, employment, a happy population that's working and has a job, and a controlled price level, prices that are in control. Those are really the best two things to target. And any tampering with independence, I think, would be a terrible idea. And I think would have very, very possibly severely negative consequences for the value of our financial assets because of the Fed's control over short-term rates and the Fed's relative independence right now that allows it to make decisions free of political interference. So this is a very concerning article to me, in my view. This is the performance of U.S. bonds in the form of the U.S. aggregate index. You see, we had this very difficult year in 2022 when the Fed raised interest rates. But year to date, look at that. We are down on the Bloomberg U.S. aggregate, which is a combination of treasury bonds. It's an index. It's the S&P 500, if you will, of bonds, corporate bonds and treasury bonds and mortgage bonds, so forth. Because of the change in the market's perception about the Fed's intent to lower interest rates, these bonds have lost 3% of their value, or rather the return, the return on those bonds. When you combine the interest rate and yield that's being paid to you in the form of a coupon payment and the change in the value of the index, we're down 3% year to date. So that's what aggregate bonds have done here in the first part of this year. Now, as I've told you, our bonds have done better because our bonds, the bonds we're holding for you, our bond portfolio rather, is shorter term than this aggregate. This aggregate's closer to a duration of 5 or 6. The duration on New Capital's bond portfolio about 3.5. So substantially less sensitive to interest rates. Nevertheless, this is the reading on bonds for this year, and you see a minus 3% stands out. Most years we've seen positive returns for bonds. This was, of course, in 2022, the big exception when the Fed raised rates so steeply. Here's a bond survey of different kinds of bonds, and you can see these are yields. So this is the yield on bonds as of April 22nd. 2-year treasuries, 4.97%, higher than 10-year, higher even than 30-year bonds. So we have not been buying these longer-term bonds. We've been sticking with these shorter-term bonds, right? And you can see that there are higher yields available. So, for example, all the way to 8% on U.S. high-yield corporate bonds. But I don't want to buy a lot of that for you, because I'd rather you get your exposure to corporations through stock ownership. These are all, except for municipals, yielding more than treasuries because their credit risk is higher in general. And you can see here in 2024 year to date what the return on bonds has been. Well, 2-year bonds basically flat. 5-year bonds down 2.5. Inflation protected bonds down 1.6. But look at 30-year treasury bonds, down almost 10%. So very, very strong reactions by longer term bonds, those bonds that are more sensitive to interest rates, strong negative reactions to the idea that we are not going to see lower interest rates instigated by the Federal Reserve. Fixed income yields right now, you can see where they are. U.S. Treasuries, and the purple line, are U.S. Treasuries are here. The purple line across all these bonds is the 10-year median, the middle observation of all the data. And you can see that by and large, the current yield, which is the blue diamond, is up toward the top of the range in almost all cases. You can see that. In other words, we're seeing yields that are healthy yields. And so that's another reason why we're happy to own bonds. We'd like them to be lower in their duration and less sensitive to interest rates. And we're doing that. But it isn't as if we're back in 2020 when the 10-year treasury hit an interest rate of 0.5%, and the 15 years or so before that when interest rates were so low. You and I, as bondholders, are now getting paid a healthy amount of interest, and so we're happy about that. Here's the Treasury yield curve. This is where we are right now, April 22nd, just a couple days ago. And you can see that interest rates are now substantially higher than they were in January of 2023 and way, way higher than they were in January of 22. We still have this phenomenon where shorter term rates are higher than longer term rates, which is not the normal condition in interest rates. The normal condition in interest rates looks more like it did in January of 2022, where shorter term rates are yielding less than longer term rates. But look what's happened, right? This 1.5 and 1.9% went way up, but the shorter term rates went up even higher because of the actions by the Fed. All right, we'll turn to the stock market now. Just checking my time. We look all right. I think I'll get through the slides and end up on time here. This is the S&P 500. We could use just about any stock index in the US. It's a good one. We could use the Russell 3000, you know. Lots of indexes. JP Morgan uses the S&P 500, so that's what we're looking at. There's nothing holy about it. It's an index that is generally reflective of the US stock market. So that's what they're giving us here. And that's what we're using. And you see year to date, stocks right here, 5%. So that's the 5% when I took the poll early, and 6 out of 10 of you said, we're going to see 5% returns in the stock market. Well, you've already seen it. There it is. We're up 5% in the US stock market this year. And so we'll see what happens. Those of you who picked 5% for the return on the stock market, that's it. You're done for the year. You're predicting no further return. You may be right. You may well be right. We have no idea. You could turn out to be right, and your prediction that all the gains for 2024 are already here. That's very possible. And this chart also shows you, I like this chart because it shows you this table, because it shows you that every year you have to expect that you may see a negative period for the stock market, and we've already seen that this year. In fact, recently, the stock market has been soft coming out of Q1, and we've seen a minus 5% return for the stock market this year, which means we've seen a 10% range in the bouncing around of the S&P 500 this year from January 1 to date. The S&P 500 as a proxy for stock valuations, you can see here it is. We are near all-time highs. We've hit some all-time highs recently. I'll talk about highs later in my presentation. But you can see we're up at a peak here, right? We've climbed out of this period during 2022. It may be hard for you to remember now, but the stock market was down 20% in calendar year 2022, and we've had a 40% increase from that trough right there, that nadir. We are trading at valuation of almost 20 times earnings. How does that stack up? Well, it's on the higher side. I'll show you that in a second. So this is where the S&P 500 is right here in this table. We're trading around 20 times earnings. It has a 1.5% dividend yield. A little bit paltry, and that's in comparison to, again, here's the 10-year Treasury bond again, coming up again. There's a reason why that instrument is used. It is considered to be the risk-free asset by financial professionals. All other financial assets are often compared to the 10-year Treasury. It's considered to be a longer-term investment, 10 years, and it's considered to be free from default. It will not default. If the US Treasury defaults, the world's got problems. Even though there are those who are in Congress who often threaten to default the US Treasury on bonds, on its debts. So what about the valuation of the S&P 500? Well, right now you see it's toward the higher side. Cheap would be down here, one standard deviation of cheapness, and that would be historically around 13.4 is one standard deviation, which means 68% of the observations evaluation would be contained within here and here. If we assume that the valuation of the S&P 500 follows a normal probability distribution, for those of you who have taken statistics, we would expect to see 68% of the observations between one positive standard deviation, one negative standard deviation. And when you look at the chart here, that looks about to be the case. You know, a little bit more than 2/3 of all the observations are contained within these boundaries. And here's the 30-year average, 16.6. So we are above the 30-year average, and we are right at one standard deviation of expensiveness. We're not up here where we were in 2020 coming out of the pandemic, right? Here was March of 2020 when everyone freaked out, and then the stock market snapped right back, and we actually had a positive year of returns in 2020 and continue to see positive. And then we had the rough 2022, and we've climbed up from there. So we're not seeing this level of overvaluation, and we're certainly not seeing this level. Everybody remember what this was? 1998, 1999, 2000. Anybody remember what that was? Think back. That was the tech bubble when everything got so crazy expensive. So we're not there, but we're not cheap. Returns by size and style factors. This is year-to-date returns. And you can see that year-to-date, we've continued to see very strong performance by large cap growth companies, the big tech companies, for example. But we've also had very strong performance by blend companies, you know, might think Coca-Cola, Procter & Gamble, Walmart, and value companies. I don't know, Exxon. So it's been strong performance by larger companies across the board here year to date. Mid-sized companies have done okay, 2.5%. Small companies have struggled. Look at that. Across growth, blend, and value, small companies have not had a great 2024. Could be interest rates. Could be they're more impacted by interest rates. I don't know. And then just to take a quick look over here at how expensive things are. This area of large cap growth continues to be expensive as compared to 20-year average price to earnings ratios. And the only part of the market that is trading below 100% of the 20-year average is small cap value companies at 96.7%. So you can just see right here, the US stock market in general, it ain't cheap. It's not screamingly expensive, but it's expensive. What do I want to say about this? This is looking at growth and value, and basically the takeaway here is that right now, value companies are cheaper relative to growth. So we're still in a period, and it's been a long period since roughly 2015. We've had some ups and downs here. Right here, value approached a long-term average of parity in terms of valuation. But right now, we're still seeing that value stocks still offer some protection from overvaluation. And this is a chart that shows you interest rate environments. Here's the 10-year Treasury bond. And how do growth and value stocks do when the 10-year Treasury bond has these yields? So when the 10-year Treasury bond has very low yields, it's very clear that growth stocks clearly outperform. But this is the current environment that we're in, where the 10-year Treasury bond right now is right here. Historically, you see value stocks begin to do better and actually outperform growth stocks. Historically, from 1979 to the present, that's what we've seen. We have you in both growth and value. Your portfolio contains both, but this is what this says. All right, top 10 concentration. Look at this chart right here. We have since 1990. We have an unprecedented situation since 1996. The top 10 companies in the S&P 500, Apple and Google and Microsoft and I don't know, Meta, and I think one of what's the company that's doing the weight loss drug that's zoomed up? Is it Bristol Myers maybe? Anyway, the top 10, Nvidia certainly, now occupies 33.7%, a full third, 1/3 of the valuation of the entire S&P 500 is occupied by 10, is composed of 10, the top 10 stocks. So we have kind of an unprecedented concentration from these companies. And just yesterday, Microsoft announced strong earnings on the backs of its work in artificial intelligence, and Google announced strong earnings. Now, in contrast, Tesla, you may have seen, is having some big trouble. I'll talk about the Magnificent Seven in a bit. But you see, here's the earnings contribution of the top 10, right? We're not seeing a corresponding huge. They are huge contributors to the earnings of the overall S&P 500, but the valuation is even higher than their contribution to earnings. And you can see right here that the top 10 the price to earnings ratio on the top 10 is 26.9. The average for the top 10 from 1996 is 20.4. So it's expensive, 132%. It's expensive to own those companies. The remaining stocks, all other 490 stocks in the S&P 500, 17.4. And does that mean they're super cheap? No, they're 15.7 on average, dating back. And here's the overall S&P 500. So again, we're not cheap. We're not screamingly expensive, but we're not cheap. Here's the Magnificent Seven. Let's see, that's Apple. I don't know if I can name them all. Apple, Microsoft, Google, Tesla, Nvidia. What's the seventh one, everybody? What am I forgetting? Somebody throw it up on the chat. What's the seventh? No, I named Microsoft. Somebody throw it up on the chat. What's the seventh of the Magnificent Seven? Anyway, we'll come back to it. If somebody can name, I already named Microsoft. Amazon, that's it. Thank you. Amazon is the seventh of the Magnificent Seven. And where do we start here? Look at the performance. In 2021, the Magnificent Seven had a 40% return. The S&P 500, leaving aside, excluding the Magnificent Seven, 17%, still not shabby. The overall, when you put these two together, 27%. And then look what happened in 2022, the Magnificent Seven down 40%. So they're volatile, right? And then the S&P 500, excluding the Magnificent Seven, only down 8%. So in a down year for the stock market, you can expect these big companies, given their valuations, to struggle. And then look at 2023, last year, right? Up 76%. And then the S&P 500 overall did 24%. The rest of the S&P 500, if you took those 7 stocks out, the S&P 500 did 8%. So it's been quite a period for those Magnificent Seven stocks. Year to date, where are we in 2024? They're up 8%, still having a very strong year, although Tesla is having a tough year. And S&P 500, excluding, is up 3% total. There's your 5%. And then you can see right here the performance dispersion between the best performer and the worst performer, right? So here in 2024, the best performing, and I don't know which it is up 61%. I think that's Nvidia maybe. And then minus 43% for the worst performing among the Magnificent Seven. I think this is almost assuredly it's Tesla. A few more slides. This is international valuations. We have hit a low in international valuations versus US valuations. I've talked about this now for several years, and international stocks continue to get cheaper versus the US. That doesn't mean international stocks are not performing well. The Japanese stock market, for example, in local currency, not in US dollar terms, but if you are a Japanese citizen living in Japan and earning returns in yen, it's up 14% for the year, 3 times what the US stock market has done. The problem for US investors, including us in the Japanese stock market, is that we don't hedge currency returns because we want to give you diversified currency exposure, just like I want to diversify you in stocks, and I want to diversify you in bonds, and diversify you in industries, and diversify you in countries. I also want to diversify you in currencies. So I don't hedge currency exposure. All right. And so, but look at this. International stocks, excluding the US, have now hit 2 standard deviations in cheapness versus the US. Current price to earnings ratio on global stocks, excluding the US, 13.3. Pretty cheap. And the implications are that, and I know I sound like a broken record, the implications are good returns. And I showed you that the economies are performing well in emerging markets and in India and in other places. S&P 500, there it is, 19.9, 20 times earnings. So substantially cheaper, not just substantially cheaper, historically cheap, going back to 2004. So historically cheap over a 2-decade period are international stocks. Look at this, difference in dividends. A lot of clients are seeing really strong dividends coming into their portfolio, including coming from international stocks. The dividend on stocks outside the United States over twice what the 1.5% dividend yield is on the S&P 500, 3.2%. Look at that. So if you own international stocks, and we have you owning international stocks, unless you don't want them. If you don't want them, tell me. I'll get rid of them, and you can have US only. I'm happy to do that if that's the portfolio you want. I'm not going to stand in the way. But you're getting paid a really nice income from international stocks. And that dividend is historically high, just as the valuation of the companies is historically cheap. The dividend is historically high. That's not a surprise. As prices go lower, dividends go higher, assuming the companies are continuing to pay dividends. So what this is telling us is that the valuations are cheap, not because the companies because the companies are struggling, right? We would see the dividends not move if companies that were international companies were not paying dividends. They were struggling. Economies were bad. But that's not the case, because we can see the dividend is moving exactly opposite of the valuations. So as the valuations go down, the dividends are going up, which means that international companies are holding their dividends steady, which means they're doing just fine. The Toyotas of the world, for example, or the LVMHs of the world, or the, whatever, Shell Oil. All right. I've only got a few more slides, and we're just about at 2 o'clock. I don't know that I'm going to spend much time on this. Oh, we'll take a look at this. You can see, I'll point 2 things out on this slide. You can see that the US share of the entire world market capitalization, the value of all companies in the stock market, global stock market, has continued to rise. In 1987, the US represented 30% of the global stock market. Now it's 64%, right? So you can have 2 reactions to that. Oh, I want more US. It's going from 64% to 99%. The US is going to account for not just 2/3 of the global stock market capitalization. It's going to go to occupy the entire global stock market capitalization, and all other companies in the world are going to be worthless, except for US companies. That's one way to look at it. The other way to look at it is, we're due for a correction. And I'm assuming that the US, which accounts for what 5% of the world's population, is it? I think. Is that right? I think the US accounts for 5% of the global population. It accounts for 20%, I think, of the global GDP, and its stock market accounts for 64% of the global stock market. I'm guessing that we're maybe going to see, but who knows? And then here you can see the effect of currencies. So here in 2024, you can see that the world stock market in local currency has provided a return of 6.1%, more than the US stock market. The problem is that the US dollar has been very strong here in 2024. Why? Well, it's back to interest rates. As the world has come to grips with the fact that the Fed may not be lowering interest rates, that's caused the US dollar to gain strength and money to flow toward the US dollar to take advantage of what may be higher interest rates for longer. So you see, there's nothing wrong at all with global stock markets. Look here in year-to-date 2024 in local currency, in yen, the Japanese stock market is up 14.2%, 3 times the US. The UK in local pound has done 5.2. France, 6.4 in the French franc, 5.7 in Canada, 5.9% in Germany. China is actually down, the only stock market, that along with Brazil. Taiwan, 10.6. India, up 7%. Now, you might say, okay, New Capital, you need to hedge currency. Okay, well, look what happened last year. Last year, let's just look at Germany. Germany's stock market in local currency, the Deutschmark, did 19.8. You, the US investor, actually got a 24% return because the euro was stronger than the dollar last year. You got an extra, 4% return. So we have to be careful. When I was in business school, one of the first exercises we did was a currency trading game. Everybody got given some fake play money, and I had a class full of, I did the executive program at the University of Texas, and I was in a class with some very smart people working for Compaq Computer and Dell Computer and Shell and Exxon and so on. And I can't tell you how fast people lost money making currency trades. So you can really, really have currency trades turn against you. So our strategy is give you diversified portfolio, including diversified currencies. Where are we on valuations? You can see that these sections of the chart are more overvalued. This is the current valuation, the green dots. The lime green shows you historical averages of valuation, and you can see that US large cap, US high yield bonds, US growth companies, even US value companies, US small companies, much more favorably valued, and then developed market international, emerging market stocks, municipal bonds, even core bonds and treasuries, all showing lower on the valuation scale. I can't tell you what's going to happen, but I always like to show this to everybody so you can look and see. I just don't want clients going and chasing things that are very expensive, because the financial markets have a way of rewarding that with the back of their hand. All right, so we're at market highs. Does that mean that you should not make investments? Well, what this chart shows is it's hard to conclude that. Look at so this is the average cumulative S&P 500 total returns between 1988 and 2023. This is a long period of time. So what this means, let me interpret this chart for you, is that if you invest on any day, your cumulative return was 2.9% for the 3 months subsequent to that investment. If you invested at a new high in the S&P 500, the cumulative return on average 3 months, and this chart is showing you all-time highs, these green dots. So if you had made investments at any time during these green dots, your cumulative return from investing at a new high versus investing on any day, any of these gray areas or these areas included, the all-time highs, it's pretty hard to tell a difference. And in many cases, you even had a higher return 2 years subsequent and 3 years subsequent to the time you invested at the new high, as if you had invested on any day. So I want to caution people on timing the market and assuming, okay, the market has reached an all-time high, I can't invest. this chart shows you that's really a dangerous assumption. So any of you clients, if you have cash and you want to talk about it with me, we don't approach it because of this chart saying, you know, you just have to be so fearful that you can't invest your money. And that's also what this chart shows. I think this is the last chart, and then we can go to questions. This is CDs and alternatives. This is an older chart, and I showed this chart back in January when I did the year-end review. What this is showing is that, you know, oh, we're getting 5% CD yields right now. That's true. But look what happens at the end of a rate hike cycle by the Fed when we hit a peak 6-month certificate of deposit rate, because the Fed has stopped raising rates. Okay, well, the gray is the return to CDs, certificates of deposit, cash. And these are all different periods where the Fed reached a interest rate raise peak. They raised rates and they did their job and they were done. Okay, well, you had some nice positive returns for cash, but look what your alternatives did. S&P 500 for the lime green, which is stocks. Bonds, the Bloomberg aggregate is this dark blue. A 60-40 portfolio, combination of stocks and bonds. All of these other alternatives did even better. So we have to be careful about saying, oh, I just want to hold 5% CDs. You may miss out. And in fact, that's exactly what would have happened last year. If you had said, I just want certificates of deposit, you got 5% last year. But, you know, stocks did 20%. You know, bonds did whatever, 7-8%. Okay, I think that did it. So I ended just a few minutes past. We're ready to take some questions if there are any.
First question is, how is AI going to affect the market?
Well, AI has already affected the market. It's a good question. I don't know if the question is exactly what will its effects on market returns be, or what will its effect on market trading be. There are a lot of effects that AI will have on the market, and I just think it's going to be very significant. So maybe I'm answering my own question. I think you're going to see significant effects in trading for sure. I think you're going to have trading algorithms that are going to be running off AI, and it's going to generate huge amounts of volume. So I think what are already enormous volumes being traded, not by new capital, but by, you know, day traders and quantitative trading firms and market makers and so on, I think we're going to see even greater amounts of trading volume. So I'm pretty sure you're going to have AI programs, if you don't already, that are just basically running constantly. And that's a little scary. You know, it could result in some occasional market breakdowns. Some could be significant. In terms of returns to the market, we've already seen it. You know, NVIDIA stock up from nothing, a company that's existed since 1993 and made a bet on chips that would operate for video games being modified and repurposed to be used for AI, and the company's got a $2 trillion valuation, and that's gone into everybody's portfolio. You know, we don't buy individual stocks for you, but the U.S. stock fund that we own for you, NVIDIA is at the very top of it, and so you're benefiting from that. And so to the extent that AI represents a new area, just as the internet did, and just as the semiconductor did, AI seems to represent an entirely new area that is a boon for economic growth. And so you know, I think that's going to continue. So I'm positive on AI. I think it's good. We're looking at some AI things here at New Capital. that would be helpful in helping us accomplish what are otherwise more difficult administrative tasks. Let me give you a good example of that. Meeting notes. When we meet with you, I take notes. And it's not that easy to both listen to you and take notes and figure out while I'm listening to you what's important about what you're saying, what needs to be a note. And then after I take the notes, I give them to Casey, and Casey's got to take them apart and enter them into 360 for the meeting. And so we have a record of the meeting, and we can go back and look at what we talked about and what we said. Well, we're looking at and some of you may have used some products that listen to your meetings, participate in your meetings, and then turn that into notes. So we're looking at some products that can do that, use artificial intelligence, take our meeting apart and break it into things that are tasks for New Capital to do, things for you that you may need to do, whatever you need to go get your estate plans updated, for example, would be something you need to do. I can't do it for you. So the prospect there is that we're not going to have this big administrative burden and overhead for us to take apart meeting notes, and Casey doesn't have to read my handwriting anymore. So that's just a very simple example of how AI holds out. Sorry, what?
I said Casey's laughing back here and agreeing.
Casey's laughing. But you know, so, and there are all kinds of professions that could benefit from that. If you're a lawyer in meetings, if you're a physician, right? If you're a physician meeting with a patient, and there's the prospect that you're just going to put your recorder there and the computer's going to do the rest. It's going to listen to what's going on with your health, and it's going to put everything into a data format that can be used and analyzed. And so I'm hopeful about AI, and there's a lot going on. And just as the American way is, and frankly the business way now all over the world, whether you're a software engineer or an entrepreneur here or in India or China or Europe or wherever, there are all kinds of our best minds who are thinking about, how do I make a product that's going to help somebody? And we've got companies coming to us at New Capital to help us with our meeting notes. And I promise you, the one company that we're looking at right now is not alone. So I think it's going to AI is going to affect the market from trading, and it's going to have very significant benefits as well for businesses large and small. Okay, next question.
Yeah, we've got 2 more in
all right. Is there a way to compare private equity money pools against the U.S. stock market? Great question. And there is a lot of research that's going into looking at private equity right now. MSCI, the large index provider, recently purchased the largest provider of private equity indexes. That company is called, I forgot. But at any rate, MSCI purchased that company. And so we can expect to start to see private equity indexes showing up as MSCI indexes. And it may already be happening. I haven't looked in a bit, but there are a lot of efforts right now, including by one of our business partners, Dimensional Fund Advisors, to do academic research. One of the problems with private equity is that they report their returns on a lagging basis. The stock market gives us an update by the minute, but private equity will send out something, once a quarter, if that, maybe once a year, and they don't value their assets, and they're invested in their investments, except every so often, and the valuation may be by a single person doing an appraisal. So the valuations lag. And so statistically, you have to do what's called, you have to do a lag. You have to do a lagged variable to make them equal in time to be able to compare them. And so there's a lot of that research that's going on. So Phil, it's a great question that you ask, and I would say that these comparisons between private equity performance in attempt to show what is private equity performance on a properly adjusted basis, so that private equity providers don't just go out and make claims that can't be compared to the U.S. stock market. So it's a great question that you ask, and there's a lot of work that's being done on that area. And when it comes out of the kitchen, I'll be happy to show you what the best thinking on that is. Right now, it's sort of in academic land, and the research is very quantitative and beyond even my ability to totally digest it. I'm not a quant stat professional. I've had statistics courses and math courses and so on, but right now we still need to wait for the results to come out. And Philip, by the way, I can send you a paper from Dimensional that starts to answer these questions. And so if Catherine, you'll make a note for me to send that off to Philip, who asked the question, we'll send him that report, but we'll have to get it from DFA first. Good question. And by the way, we can buy private investments. Here at New Capital, we've got access to the two major platforms for advisors, where the likes of Blackstone or Carlyle and so forth offer their funds through to our clients. One is called CAIS, CAIS. The other is iCapital, and we're on those platforms. But I don't have a lot of clients, if any, that are saying, give us private investments, right? Because it's not they're not liquid, the fees are higher, and most clients just go, I don't want that. But if any of you said, I want that, we'll be happy to do some research for you. Okay, next question. All right, Dan asks, any update on us having a tax accountant? Yes, there is an update. And the update is JC and I have worked on the ad that we're going to run. We worked on it just a few days ago. We've probably got one more drafting session to get it the way we want it. And then we're going to run it. And then we'll see what comes back. So we're in the process of doing that. And I think more than ever, this is a service that our clients want. It's gotten really tough, I'm sorry to say, to work with the CPA industry. We think we can do a better job and really give a good integrated experience, where we bring your financials and reports in 1099s down from Fidelity and turn that into 1040s and so on. But I just want to caution everybody, you know, we'll have to go through state licensing and regulatory procedures. We'll have additional insurance burdens on us for errors and omissions. There's going to be a whole lot of stuff. And most of all, we've got to find the right person, because think about the disaster if I brought on somebody to do this work, and then all of your returns came to us, and I said, okay, we're ready, and you brought us the returns, and then they said, I'm leaving. So it's got to be the right person who commits to New Capital, and New Capital commits to them, and we like them, and we have a long history of being able to do that. Our team is so incredible. Amazing. And that person will have to fit into this amazing team and be amazing too. And you know, that takes work to find that person. So that's the update, but we're working on it. Thanks for the question. And then one more question. Jim and Naomi want to know, what is the effect of AI on technology? Oh, it's boundless. It's affecting the design of chips. It's affecting the investments of the largest companies to the smallest. It is impacting how software is written. Software is now being written not by a programmer sitting there and writing every single line, but there is now an enormous amount of code that can be generated by simply telling the computer, please write me a program that let me think of an example. Please write me a program that tracks my food intake and allows me to put in the type of food that I am eating at each meal, and calculates the amount of calories automatically, and then sends me an email to this address if I exceed the number of calories that I want to eat. You could probably write that program, Jim and Naomi, simply by getting the code generator and saying the sentence I just said, and it will actually create that program. Think about that. I began to program back in the late 70s at school in junior high when I was at my first computer class. The computer was the size, it was a Texas Instruments like mini computer, and the computer was the size of my desk. And I've got a pretty good sized desk. It's probably 6 feet wide, and and it was that big, and there were terminals. And the first program I learned to write was in BASIC, which was probably the very first program ever issued by Microsoft, the young company at that time. And I should have bought stock back in 1978. And I wrote a program. The assignment I was given along with my classmates was to write a program to do a golf ball. You'd hit a golf ball, and then there would be a randomize, and the computer would randomize how far the ball went and the direction. And so I wrote a golf, and every line had to be written line by line by line by line. And for the most part, that's still how software is generated. But we got notice the other day that the platform on which we have produced NCM 360, the platform is called Knack. They now have put in their own code generation module, and you can actually generate we haven't tested it, but you can actually generate a program on that platform that we use to create NCM 360 and have the AI generator automatically make a program for you. So the impact on tech, it's incalculable. It's vast. And that is exactly why we're seeing such rapid growth in the industry and high valuations being placed on the businesses. I hope that helps answer the question. I think that's it for the questions. That's it for the presentation. I want to thank everybody, including Catherine, as always, for her fantastic work in getting us set up. Thank you for spending your time with us today. And for those of you who are going to be coming on the 11th, I'll look forward to seeing you for that party, and it should be a wonderful evening. So until then, take care and have a great day.